Hello everyone and welcome back to my channel. In continuation of CFA level 1 prep revision series, in this class we are continuing with fixed income, cash flow structures and instrument types, and this will be the second session of the revision. In this class we are going to mainly focus on the contingency provisions in bonds, which are also considered as embedded options in bonds. So what are contingency provisions? See, on happening of certain events in future, if there is a change in the structure of the bond or the structure of the payment or in the conditions of the bond, then we identify these as contingency provisions, and these are basically treated as embedded options or options embedded in a bond. So when we talk about contingency provisions, we have three typical types: the call provision, the put provision and the conversion provision. So call provision makes the bond a callable bond, put provision makes the bond a putable bond, and conversion provision makes the bond a convertible bond. If there is a bond without any contingency provision, means without any embedded option, we identify these bonds as option free bonds. Now what I would suggest you is, when I am giving you some important notes over here on screen, I will not be able to give you enough time to note it down, so you can pause the video and take note of whatever you want to write down, or else you can take the screenshots and use it later for your reference. So under this heading, contingency provisions in bonds, under concept number 7, that is contingency provisions in bonds, you would write, often referred to as embedded options. These are special clauses included in terms of a bond or other fixed income security that allow for specific actions or changes in bond terms under certain conditions. These provisions are designed to provide flexibility for both the issuer and the bondholder, often in response to changes in interest rates, credit conditions or other market factors. So continuing further with your important notes, you can write types of contingency provisions or embedded options. Number 1, the call options embedded in a bond, which makes the bond callable bonds, put options embedded in a bond, which makes the bond putable bonds, and conversion options embedded in the bond makes the bond convertible bonds. Contingency provisions are called embedded options because they are built into the terms of the bond itself, giving either the issuer or bondholder specific rights that can affect the bond's cash flows or maturity. A bond without any embedded option is termed as option free bond. Alright, now let us move on to the next point of our discussion within this, that will be callable bonds. So what are callable bonds? When a call option is embedded with a bond, the bond becomes a callable bond. Now who is going to call the bond? Basically, bond can be called or put for premature redemption or repayment. So who will exercise a call? Who will demand for early repayment by making a call? It is the issuer of the bond. So basically, you know one thing very well, that call means the right to buy. So understand one thing very well, the investor is already holding the bond. So who has the right to buy from the investor? It is the issuer. So when the issuer has the right to buy the bond from the investor or the holder of the bond, then it is basically exercising the call. So that call is the right to buy the bond, and the bond becomes a callable bond. So what happens? Issuer observes that after issuing the bond, there may be fluctuations in the market interest rates, and imagine a scenario where the interest rates are declining. The bond will be having a need to be called back. Why? Because if the interest rates are declining, say the original bond was issued at a coupon rate of 8%, but the prevailing market interest rate is now only 6%, then why the issuer should continue to bear higher borrowing cost? The issuer can call those old bonds and square it off and issue new bonds at a lower coupon rate like 6%. This will be an advantage to the issuer of the bond. So understand one thing, callable bond is at an advantage of the issuer. Because it is at issuer's advantage, something has to be done to compensate the investor, and the bondholder or investor gets compensated by a little higher coupons. Now what will be putable bonds? If I just discuss it in one line, putable bonds over here would be opposite of these. So put means the right to sell. When put means right to sell, the holder of the bond will be having the right to sell it back to the issuer. Idea is very simple. When will this happen? This will happen generally when the interest rate starts rising in the market. So what investor observes, that investor is holding a bond which is offering coupon rate of just 8% and the market interest rate has risen to 10%. Then holder would believe, why should I earn low rate when the market interest rate is 10%? I would want to exercise my put, that is exercise my right to sell it back to the issuer, and with the proceeds obtained, I will better buy a bond which will offer a higher coupon rate like 10%. So let us write some important notes about callable bonds and followed by putable bonds. So first of all, under concept number 8 heading callable bonds, you write callable bonds give the issuer the right but not the obligation to redeem the bond before maturity at a pre-specified call price, which is basically a fixed price call on defined dates. So one thing you should be very clear, that it is not going to happen that the bond issuer can make calls at any moment. There will be specified dates and there will be a fixed price that will be specified as call price. Means the price at which the bond will be called, the date at which the bond can be called, both are specified. This benefits the issuer. I have already explained it to you. Let me just enlarge the screen size. If the market interest rates fall, that is YTM goes even below the coupon rate, the issuer can refinance by calling the existing bond and issuing a new bond at a lower rate. It offers flexibility to restructure capital or use surplus cash. You should be very clear about one thing, that suppose there is no change in the market interest rate, but the issuer is having a lot of surplus cash flow. Then why should the issuer unnecessarily hold that cash or try to invest that cash when already there is a big liability towards the bond? It's better to repay that liability so that you are most benefited in terms of the interest rates. As a result, when there is a surplus cash, then also callable bonds can be called upon for premature redemption. So I'm sure you would have taken note of this. If not, you can pause the screen and do the same. And now let me take you ahead. Price ceiling effect. If the market price of a callable bond exceeds the call price, investors anticipate the bond will be called. Hence, the bond price is capped at or near the call price. Theoretically, a callable bond's price should not exceed the call price. Now, this is going to be an important feature that you must understand. The price of a callable bond will never go above the call price. This is basically a feature of a callable bond, and that is quite realistic as well. So you should understand that these points may be important for your exam questions when they are asking certain features about these kind of callable or putable bonds. Anyway, moving ahead, we will continue with writing about investors' disadvantage. Investors face reinvestment risk as they may be forced to reinvest proceeds at lower yields when bonds are called early. Therefore, callable bonds typically offer higher yields to compensate investors for this risk. Alright, now moving ahead, what you can further write, what if YTM is greater than the coupon rate? The call option loses value and the issuer has no incentive to call the bonds when interest rates are high. The bond behaves like a non-callable bond with price sensitivity to interest rates returning to normal. On the other side, what is make whole call? This kind of situation allows the issuer to redeem bonds at a price equal to the present value of remaining payments discounted using the YTM of the comparable sovereign bonds plus spread, less favorable to the issuer due to higher redemption cost and rarely exercised and have minimal impact on investors or market valuation. Alright, now moving ahead and taking up the discussion on putable bonds. While explaining callable bonds, I have already given you a brief description about putable bonds. Putable bonds are options with the bond holders to put it back to the issuer before the maturity. This will generally happen when the interest rates in the market are rising up. Now what is happening? Understand that in case of putable bonds, the right is with the investor, the right is with the bond holder, and to compensate the counterparty, that is issuer, for this right, generally it is a lower coupon that is arranged for putable bonds. So in case of a callable bond, the interest rates or the coupon rates are generally higher than the option free bond. In case of putable bonds, the interest rates or coupon rates will be generally lower than the option free bonds. So just write up something under the heading putable bonds, and that will be under concept number 9. You can write a put provision gives the bondholder the right to sell the bond back to the issuer at a predetermined price on specified dates. This is a benefit to the investor, particularly when interest rates rise, as it helps protect the investor from fall in the bond prices. In effect, the investor has a downside protection because this feature is favorable to the investors. Putable bonds are usually priced at a premium compared to option free bonds. Alright, now moving ahead, and you may continue writing for this scenario. If YTM is lower than coupon rate, the put feature becomes less valuable and the bond starts behaving more like an option free bond in terms of price sensitivity to interest rate changes. Strategic use of poison puts. Now what exactly are poison puts? Let me explain it to you. Imagine a bond embedded with a put option is purposely issued for hostile takeovers to be avoided. So what happens when there is certain takeover which is not beneficial, and under certain situations, under some kind of pressure, if that takeover bid is to be executed, to discourage the buyer of this whole business, what can be done? You can have a substantial portion of putable bonds, and the moment some conditions like this trigger, the bondholders will exercise their put and claim immediate cash from the entity, and this happens if the ownership changes. So basically, to provide for kind of protection against this kind of hostile takeover, if there is a putable bond included in the bonds structure or in the capital structure of the entity, then we can use the term poison put to identify this situation. Let us write something about this poison put as well. Put provisions can also serve as a defensive mechanism. By issuing bonds with put features, a company may deter hostile takeovers. These poison puts work by creating an immediate claim on issuer's cash in case of change of control, for example acquisition, making such takeovers financially unattractive for the acquirer. Alright friends, now moving ahead and taking up into discussion the next embedded option, that could be a conversion option, which makes the bond a convertible bond. So generally understood, conversion is not forced upon the investor. In that case, investor will not be interested in buying the bonds. But still, there may be certain convertible bonds which could be dependent upon contingents, and then when those conditions trigger up, the bonds will be compulsorily converted into equity. Otherwise, convertible bonds, what we generally understand, will always be convertible at the option of the investor, and this bond is getting converted into the issuer's equity. So when conversion option is attached with the bond, and the conversion can be exercised at the option of the holder, it is again a benefit associated with the bondholder, and therefore again, because the benefit is with the bondholder, the bond issuer will be offering lower coupon rates for such bonds. Now what happens in case of convertible bonds? The bondholder will exercise the conversion option only when the conversion value is attractive. For example, the par value of the bond is $1,000 and the bond is convertible into 10 equity shares of the issuer, and each equity share has a market price of $120. then $120 multiplied by 10 shares will make it $1,200. So the conversion value of that bond becomes $1,200. If the bondholder is asking for cash redemption, will be getting only the par value, that is $1,000. Why would someone ask for a par value of $1,000 when the conversion value is $1,200? So what makes it attractive is the share price of the issuer. So the conversion value is linked with the share price of the issuer. As and when in the market the share price of the issuer rises, the conversion value of the bond also starts rising, and that makes the convertible bond more and more attractive. Imagine a situation where the share price of the issuer is falling significantly. The bondholder is protected because the bondholder would still get the minimum value of the bond as the par value of the bond on its redemption. So let us write some important notes about convertible bonds. So under the heading concept number 10, convertible bonds, you may write: a convertible bond is a type of bond that gives the bondholder right to convert the bond into a specified number of issuers' equity shares, typically at the discretion of the bondholder. Price sensitivity: the price of a convertible bond tends to move in line with the issuer's share price. If the share price exceeds the conversion price, the bond's price tracks conversion value more closely. If the share price is well below the conversion price, the bond behaves more like a non-convertible bond. Alright, then moving ahead, we would further write types of convertible bonds. One could be the standard convertible bonds, that is redemption for equity occurs at the bondholder's discretion, usually when the share price rises. Another could be contingent convertible bonds or COCOs, convertible automatically when a specified downside event occurs. For example, capital falls below a regulatory threshold. Alright, now moving forward and talking about the yield characteristics. Convertible bond offers lower coupon payments than callable or putable bonds. Investors often accept lower YTM, even zero, in exchange for conversion rights. Hence, issuers pay less interest on convertible bonds, making them cost effective for financing.